what can we expect in 2023 in the first couple of quarters?
Very likely new lows.
You just got done saying that the stock market and crypto market, at least for now, are working in tandem, right? They're going to go up together and down together because it's crypto, particularly Bitcoin, is kind of pegged to the stock market for now.
For now.
What does that mean? What can we expect in 2023 in the first couple of quarters?
Well, this is my note, and this we will play again next year for better or worse. I'll first prognosticate that I think the stock market right here at the end of the year is kind of signaling where it's going to go early next year.
Really? Okay.
Yes. Sadly, I feel the stock market is prone for more lows and very likely new lows sometime within the first quarter or second quarter of next year. The Federal Reserve is trying to draw out the pain by keeping rates high. Yes, they've only increased by 0.5% in the last move, but don't not expect more half-point hikes. We are now sitting at the highest Fed funds rate. I believe we're at 4.5 area, and I think we can go to 7 before this is done.
Got it.
7% is not good for a lot of businesses. This is why the tech sector has been under such pressure. The tech sector is sensitive to interest rates, just like the housing sector. That's why the tech sector has already owned its pain. They have already created layoffs. There are more layoffs scheduled for next year on the big players, the Googles, the Apples, the things that Amazon will lay off in January. They always do. And other tech sectors from Netflix to Meta. Everybody's already announced their layoffs, huge job cuts across the board. And if this is the case, that means they're anticipating the problems again coming next year. Most of these stocks have hit COVID lows. Amazon, for example, is below COVID lows. Apple is now 126 area, making a new low for the year today. And you can see that these are stocks. I believe Apple will go below 100. That is not bode well for the Dow Jones or the S&P 500. I expect new lows in the first quarter or second quarter. The way determining which quarter it is all about Jerome Powell and how aggressive he gets and how much he wants to hold off the pain. So he may miss a rate cut or a rate hike, and then maybe the next month he'll put the hike in. So the market will think, oh, he's not hiking anymore, and therefore they'll probably put maybe a little rally in it, but then they'll hike again because inflation is not easy to tame. This is not like a clock where we can find out the gear that's bad. This is something that is far from a science. It's a lot like an art. And so
it sounds like an art in doing the opposite of, how you say rip off the Band-Aid really quick and just get it done. It sounds like they're doing the exact opposite of that. I can't think of a good saying for it right now, but it sounds like they're trying to draw it out. Is that right?
Yes, he's trying to draw it out. Why? Because he doesn't. The Federal Reserve, unlike European central banks, has a dual mandate. The dual mandate, everybody's aware, is to maintain employment and also maintain price stability. Other countries, their central banks have the job of managing inflation. Europe has understood inflation all the way back to the 20s. And they are adamant not to recreate that because at the end of the day, Nazi Germany came out of inflation from the Weimar Republic. So we don't want that again. Europe doesn't want that again. So that's why their mandate is all about the price stability. Our mandate, on the other hand, says that our Federal Reserve chairman has to manage price stability, but also maintain high employment. He can't do both. These things run together. The higher the employment, the more likely it is to have inflation. This isn't like the Laffer curve or anything like that, but it is a well-known science in any world under monetary policy that if employment goes to a max, you are likely to have inflation at some point. And by the way, folks, we just added the largest budget in history in this country at 1.7 trillion. And Republican, Democrat, or independent, that is a large bill. And we know there's a lot of meaningless spending in it. We don't even know what it is. But those are things that now Chairman Powell has to be able to manage. He is getting no help from the federal government, unlike the 80s, where he did get help from the federal government, where they did cut taxes and they cut expenses. So we have a real problem here as we come out of COVID and the federal government insists on spending money to help families, which is a good thing. But at the end of the day, there is a cost to that. There is no way around higher taxes in the future. You can't cut taxes out of this kind of spending. And if you have higher taxes, again, that is also going to drag the economy. So for 2023, the first 2 quarters, look for them to be volatile to the downside. I expect at least another 20% lower. And a year from now, we'll replay this and see how wrong I am or how right I am. And by the way, that doesn't mean the year will end on a bad note.
Right.
But know that in the first 2 quarters, look for there to be a lot of instability, a lot of instability in price, and look for people to be laid off. Look for lower housing prices. Look for marginally lower crypto prices. So even if the stock market goes down, and they are correlated, they will go down together with crypto. Crypto has hit an interesting floor because the FTX information, for example, only moved crypto 15%. Now it seems like a lot, but on a nominal basis, it was only 3,000 crypto dollars, not the 50,000 crypto dollars that were lost prior to FTX becoming transparent with their problems.
Absolutely.
So this is a case where if the market does what I suspect it will do, our algorithms will remain out. Anything that has the SPY in it, which is most portfolios, will remain out. Other portfolios like Red Oil or SPY might have a few things in them and give you a smaller exposure to the stock market. I recommend holding on to these kind of positions in the short run and look for some time. There is a chance that the AI will give us an unusual signal between now and within the first 2 quarters to go long the market. And I will add one more thing to that. Generally speaking, we've made many presentations, and you and I talked about this the other day, Aaron.
Right.
We've all learned, and I want everybody to listen to this carefully. We all learned that missing the 10 worst down days over the last 20 years is a lot better than missing the 10 best up days. We have missed a lot of bad down days this year. I hope and suspect we will miss a lot of down days, big down days next year. But if the market at any time gets down to be down at least 40%, that kind of an area, I can tell you that putting algorithms and machine learning and derivatives of price algorithmic trading aside, generally, people that have a 10-year perspective of buying a market when it's down 40%, and I'm talking the S&P, only the S&P, you're going to do well over the subsequent 5 to 10 years. So if you're buying a market that's down 40%, I don't think people mind. I certainly don't mind of losing another 10% or more, marginally more, as long as I know my upside could be literally 80%. So there is a time when we have to be able to look at the market for what it is and what it has done historically and bet, regardless of our feelings, because it'll look terrible at the time, to make a longer term bet on the world of the United States of America and the global economies, to make a bet when the market is down sufficiently. Down 9-10% on the Dow, down 20% on the S&P, or 40% on the NASDAQ is not sufficient in my mind. That is not enough of a dip to buy. So 2023, I think we're going another 20% lower within the first 2 quarters. I think the year could maybe turn around somewhere between the end of the second quarter, beginning of the third quarter. And I have no crystal ball beyond the first 3 quarters. I can guess 9 months out and feel with some accuracy given the data that we've collected, but I'm not going to go beyond that. I will not make a year-end forecast for the market like many prognosticators do, because I don't feel that matters. It matters how we behave tactically.